All right, good afternoon. Welcome back here to Trader Minute. Great to have you aboard. Market just heard from the Fed, and you can see the initial reaction higher right away. And it's the first minute's always algorithm based, and it just boom and big volume there on that. And you can see, the market kind of settling out here, around this 2640 area here on S&P futures after this initial reaction. We still have Chairman Powell, who is going to be speaking here in 7 minutes, and his comments will be released all at once, and then he'll take question and answer after reading the comments there. But this is a sharp pop, here to the upside, about 15 points here to the upside. Market bled lower ahead of this. It got some news here through this move right here, and you can even see the volume. And this was U.S. President Trump comments about tariffs in China and tariffs possibly staying longer and all of that. So more trade war drama without any actual news is basically what we had there with that. And fine. We market continues to get those things, and there's not a whole lot to do with it because it's not actual news. And so we don't actually see the metrics in the market change. We don't see the metrics in the market shift as there is a lack of news. The reaction is going to play out, and the reaction could be sharply higher in the short run. A lot of times we see the Fed reaction reverse, and we come right back down to where the market was before the Fed. I'm not going to rule out both scenarios taking place here today. But there are a few areas where we're seeing reactions that are very sensible. One is with bonds. Basically, the Fed has said they're not raising rates here this year, and they've only put one rate hike on the board for next year. That is a strong shift in Fed policy, a shift that we haven't seen happen in a while, a shift that is sharply dovish. Sharply dovish. What does that mean? That simply means that the Fed in their policy, their economic policy, is gearing towards lower rates, monetary easing, rather than this tightening and normalization process. When the Fed goes through that, tend to see bonds move on up and move on up sharply. You can see the TLT moving on up here today. If I put on a weekly chart, or a monthly chart, you can see, the TLT is not that far off from its 2016 highs. 2016 is where the Fed started to signal they were going to tighten, right? They haven't gotten anywhere near normal. So to see bonds push into new all-time highs in the months to come and for the rest of the year to come, I think is almost a foregone conclusion. And, it is one where, looking at some call spreads on TLT and the 126, 128, 130 level for the end of this year are probably going to pay off very, very nicely. That's this shift. Yeah, there's an initial reaction in bonds that makes sense, but this is a long-term type of effect. The other thing that, this does is it puts a little pressure on the U.S. dollar. We see the U.S. dollar rightfully moving lower. The Fed's done hiking. The Fed's done with its tightening policy. Dollar lower is generally going to be the reaction. Now, dollar lower means euro higher, but it's not like Europeans are going to be tightening either, right? So there could be some relative risk there, but we are seeing a big reversal in gold. Gold was down pretty good here today, snapping back quite a bit. I have not found a good entry point into gold just yet. With this, nice pullback finally, nice little snapback. I would like to be involved on the long side of gold, but still looks like it needs some consolidation in the short run. But in terms of the long run thesis for gold, all this does is prop up the long run thesis for gold and the bullish thesis there for gold. And I think it actually strengthens the bullish thesis for gold quite a bit. Quite a bit here overall. If we look at the banks, right? If we look at the banks here today, you can see the banks selling off on this. Bonds up, dollar down, gold up. And why is the Fed raising rates or not raising rates? What did they say? What's going on here? Well, this is the conundrum the market's going to have to deal with. And this is one of the reasons why I think the bears have a better argument right now in this market of a bear market over the course of the next 18 months than they have had in a long, long time. And when we come in, and let me grab it here, the economic projections of the Federal Reserve Board and members under their individual assessments, and basically what they did is they lowered all their economic numbers. They said, hey, the economics are getting weaker. We see that. We're going to react to it. We're going to, come into an easing policy more than a tightening policy. And so they're basically saying that economic growth has slowed, that it's slow enough to require them to change course on policy. And what does that do? What type of risk is that? Well, you basically have the Fed saying, look, the risks are elevated. The risks are much greater than they've been in a while. And, is the Fed action enough to eliminate those risks? I would respond by no. In fact, the Fed action, to me, highlights those risks rather than diminishes those risks. But the initial reaction is up. The initial reaction is probably right in terms of the overall broader market. There's kind of this relief sense. No more raised rates. Okay, maybe the global economy can get through this without the Fed, hammer down. The Fed actually making it worse. But it is one where, does the Fed have room to do a heck of a whole lot as they've, really not gotten back to a normalization process. And I think in the coming weeks, we're going to hear a lot of debate between, this idea of slowing global economic growth and, and basically falling rates because, that TLT, that's the back end of the curve, right? This is the back end of the curve. So we're seeing rates on the back end of the yield curve drop. In fact, let's see if I can if they'll give me it in real time here. These are normally the same day. Let's see here. Yeah, they're not updated till the next day. Let Market Watch will sometimes update them in real time. Some of the data for bonds can, is not always available at real time. Here we go. Rates. All right, there's the 10-year. All right, they're not showing all the others here. Let's see. Yeah, I'm not going to waste too much time here. But what you're going to see is the yield curve actually flatten with this action. That would be the historic nature, is to see the yield curve flatten with this. And yeah, so here we go. Let's see. It's just performance of the Dow. I'll get the yield curve data, and we'll take a closer look at that. But, this is something where it is going to put pressure on the yield curve. The yield curve is going to flatten, and it's going to put pressure on banks. It is absolutely going to put pressure on banks as things go forward and put a positive spin here for bonds, for gold as we go forward. I think that is the key takeaway here from the Fed today. Now, short-term reactions and all of that, stuff that was in the green is, initially rallying to go significantly greener. Stuff that had dipped briefly into the red is bounced on back. In fact, the S&P continues to kind of mount a little bit of a charge here as the interview has been released, and you can see the stuff that was in the green is getting significantly greener. Here today, a lot of the stuff in the red is reversing back. Some of the tech that was in the red reversing on back. This is kind of a mass money flow, inflow here into the market on this Fed news, except for when it comes to the banks. And you can see this has been kind of money out here for the financials on this news. And, when you look at what's happening with the yield curve, it definitely makes a lot of sense. I think this takes some of the luster out of stocks like an AT&T. High yield names, take some of the luster off of them. The utilities, it takes some of the luster and the long term off of them. My apologies. Utilities makes them actually look a lot better because you're talking about lower treasury yields. So the relative yield on utilities is significantly better. The relative yield on AT&T significantly better. And so some of these high yield names are going to look fundamentally stronger than what they have been based on this Fed's action. So that's what we are seeing kind of take place and happen here with the Fed. Again, we're only 30 minutes in, and it's not like the reaction is over. I mentioned earlier today, I think the real reaction, is, or where you can kind of say, hey, the reaction is final, the reaction is in, is kind of after the first hour of trading here tomorrow. Okay, tomorrow morning. Now for the challenge, I have cash, I have about $1,500 in cash, and then I have some Home Depot puts, which I made a decision near its highs yesterday to go ahead and hold, and to wait out some of the upside, knowing the risk here is, up here to this 200-day moving average, and up even just a little bit higher than that. I got a couple comments yesterday as Home Depot reversed and closed near its lows. Oh, HD's looking great. Now, a long way to go, right? We haven't seen HD break any key levels that would suggest this kind of short-term rebound risk is gone. Okay, I would like to add to it. Overall, I would really like to add to it. It is one though that I would need to see that 7-day moving average get broken, and barring something major, this may kind of drift up into this 187 area, 188 area. Is still the risk here on that. With this gap from back here in February, I do not expect that it just blast through this gap and blast on higher, but that is a risk factor that is out there, and I'm willing to take that. Now, as far as another entry, the stuff that I would like to enter and to get into, it just hasn't signaled. Right, it just hasn't signaled. I know Caterpillar was trading on lower and it broke the 7 here today, but ahead of the Fed and all, no. Not with the market conditions the way that they are right here at the moment. And I totally understand that there are a few of you out there that are very anxious to get on the heavy put train with me and go. But it's easy to go and hit the button and go, hey, you know what, go. It's another thing to get the signals, and I need to see the signals. I need to see the confirmation. Playing some of this just kind of longer term bearish bias, did not pay off for me with the XLY, right? And it so far is not paying off for me for Home Depot. But it is something where, those short-term signals, they have tended to get some nice follow-through. And so as I get those, I'll continue to hold Home Depot for that, that eventual drop here. But to put the rest of my cash into play, I need to see that short-term signal, those kind of breakdowns start to happen at the levels that I want to see them happen at in order to get in. And, where things are sitting right now, for the most part, it's not giving me anything to get too excited about. Now, if we do see the market, close near where it was, around the Fed release here today, which the longer we stay above, above the reaction highs, the lower the odds of that happening are. But if we do see that happen, that could change things a little bit, in terms of some of the short-term charts. But as it looks right now, this is being used as, as another one of those kind of fund manager have to chase in type opportunities. And we do see that, taking place here this afternoon. And, is probably, probably something where you can look at today's lows and say, hey, there's some significance there, but I still don't think it's all that great without any sort of real material breakdown in the market internals, which, let's face it, even at the lows of the market today, as we talked about, wasn't happening. Wasn't happening. The only thing the bears really have in terms of breaking down is this IWM relationship, the IWM-SPY relationship here. Really interesting to see the IWM, with such a rebound, even though the KRE is pushing into new lows here. I suspect a lot of that comes from transports. Yeah, a little bit of snapback in transports. Maybe a little biotech. Yeah, a little biotech, snapping on back here today. So, helping the IBB or helping the small caps to snap back a little bit here overall. Okay. So anyway, that's, initial kind of look, initial kind of reaction to what we have out here. I think the Fed has created a very interesting long-term debate, and one that, as some of the market of euphoria wears off, is going to be one where I think the bears actually have a bigger argument than what they have had. And it's one where we're going to see a flattening yield curve. So banks are going to be laggards. Banks are going to be absolute laggards here going forward. And so, we can like the valuation. I can like the valuation on a Bank of America and things like that. They've basically taken the profit center of these banks and said, we're gonna hit it. We're gonna hit it. We're gonna smack it, and we're gonna do so because we're worried about what the economy is doing overall. Banks will survive, but it's definitely not a decision that someone like Jamie Dimon or Bank of America CEO or board is looking at and going, this is great. No, they need the yield curve to steepen, not to flatten. And I think the action that the Fed has taken here today is one where it will result in ultimate flattening of the yield curve. And it gives credence to kind of that argument from some, and you've probably heard a few high-profile investors out there calling for a lost decade here in the U.S. I think it's a kind of a, just one of those kind of arguments that's, whatever. It could happen, right? But it's one that I don't know how relevant it is to a whole lot out there. But this is something, this Fed action here today is something that actually gives a little more credence, to that type of an argument. Thanks for hopping on. Have yourselves a great one. I will jump into a new trade if we see some major change this afternoon. But barring that, I'll go into the close as I am and look to react to the action in the morning and how things kind of settle out here and to some signals that come in. Again, thanks for hopping on. I will talk to you later. Take care.